You know those self-storage places you see everywhere, on the side of the highway, tucked away in industrial parks? You've probably driven past 1,000 of them. Well, today, we're going to unlock the surprisingly complex economics behind that simple business by taking a really close look at one of the biggest players in the game, CubeSmart.
I mean, it sounds almost too simple, doesn't it? Renting out empty boxes. But that incredibly straightforward idea has built a massive, multi-billion-dollar industry. So the real question we're digging into is how? How does a company that just rents out space turn into a real estate behemoth? So at its heart, CubeSmart is a real estate company. Simple as that. They are a REIT, a real estate investment trust, which just means they own and manage the actual physical properties. And their money comes from the monthly rent people like you and me, or maybe a small business, pay to store all our extra stuff. It's a really tangible, easy to understand business model.
Now, for any good investment analysis, you've got to have a target, a goal, right? And the one we're working with today is super specific. The big question is, can CubeSmart deliver an average annual return of at least 9% over the next 16 years? That's our yardstick. Everything we're about to look at is designed to help us answer that one single question.
So here's our game plan. We're going to start with the basics, the business of boxes itself. Then we'll zoom in on what it's actually worth and dive deep into the financials. After that, we'll weigh the pros and cons, look at what the future might hold, and then finally, we'll land on a verdict. All right, first up, let's really get our heads around the business itself. Before we even touch a single number on a spreadsheet, we need to understand what makes this company tick. What drives customers to their door, and what, if anything, protects them from the competition. And here's what's so interesting. The demand for storage isn't really driven by a hot economy. It's driven by life events, what some people call the 4Ds: dislocation, downsizing, divorce, and death. Plus, businesses needing inventory space. These things happen no matter what the stock market is doing, which gives the business this incredibly stable, almost defensive quality. So, does this mean CubeSmart has some massive, unbeatable competitive advantage? What investors call a moat? Well, the analysis says it's pretty narrow. I mean, think about it. When you need a storage unit, you're not going to drive 45 minutes out of your way for a specific brand, right? No way. You pull out your phone, you type storage near me, and you pick the one that's closest and cheapest. Their advantage is super local, not some giant fortress. Okay, now for the million-dollar question. Or in this case, the $33.50 question. What is a piece of this company actually worth? This is the absolute core of value investing. Figuring out a business's true intrinsic value completely separate from its flashy price tag on the stock market. So, after running all the models and crunching the numbers, this analysis lands on a blended intrinsic value of about $33.50 per share. You can think of that as the best estimate of the company's true fundamental worth. But, and this is a big but, the price you would have actually paid on the stock market at the time of this analysis was $38.23. See the difference? And that brings us to a really key finding. The stock is trading at a premium to what the analysis suggests it's worth. For an investor, that means there's basically no margin of safety. You'd be paying more for the company than it's fundamentally worth, and that's generally a risky spot to be in. Okay, so that's the big picture valuation. Now, let's pop the hood and take a look at the engine itself, the company's financial health. Because, the numbers always tell a story. Let's see what this one says. First up, return on invested capital, or ROIC. At 4.51%, what does that really mean? Well, think of it this way. For every $100 that CubeSmart invests back into its business, buying new properties, upgrading old ones, it generates just about $4.51 in profit. That suggests it's a solid, steady business, but maybe not an incredible wealth compounding machine. Next, let's talk about debt. The company's long-term liabilities are more than 6 times its annual free cash flow. Now, that doesn't mean the sky is falling, but it does tell us the company is carrying a pretty significant amount of debt. And that brings up a really important risk. And the source material uses this analogy that I just love. It says, this level of debt is like hiking with a heavy backpack. On a bright, sunny day with a flat trail, you're doing just fine, it's manageable. But if a storm rolls in, say a storm of rising interest rates, that backpack suddenly feels 10 times heavier. Refinancing all that debt gets a lot more expensive, and it puts a real squeeze on the business. All right, let's zoom back out and get a more balanced view. It's time to look at the company's internal strengths and weaknesses, and then check out the external opportunities and threats it's facing. And this chart does a great job of showing the balance of power here. The company's biggest strength, that stable, reliable demand, gets the biggest slice of the pie at 35%. But look at the other side of the ledger. The weaknesses and the threats, when you add them together, form a 45% counterweight. So you can really see the tension in the company's profile right here. So with all of that in mind, what could the future actually look like? This is where the rubber meets the road. We're going to explore a few different potential outcomes and figure out what price would actually make sense if we want to hit our target return.
The analysis maps out 3 potential paths. There's a bear case, valuing the company down at $25 a share. That's if things get tough, like oversupply in the market. Then there's the base case, which is our intrinsic value, around $33. And finally, the optimistic bull case sees the value climbing to $42. But here's the kicker. The market price is already way up there, almost touching that optimistic scenario.
And this table really brings it all home. Remember our goal from the beginning, a 9% annual return over 16 years? Well, according to this chart, to have a shot at hitting that goal, you would have needed to buy the stock at $27 per share. $27. That is a world away from its market price of over $38.
Okay, we've gone from the 30,000-foot view all the way down into the weeds. Now it's time to put all those pieces together, tie it up with a bow, and land on a final verdict based on everything we've seen in the analysis.
So let's just quickly recap the most important takeaways. Number 1, this is a simple, resilient business that thrives on life's transitions. Number 2, it kicks off a lot of cash, which is great for investors who want income. 3, it looks pretty fully valued right now, meaning there's not a lot of obvious upside from its current price. And 4, the amount of debt it uses creates a very real risk if interest rates go up. And if you take just one single thing away from this deep dive, let it be this quote from the analyst, because it sums everything up perfectly. The company is priced for safety rather than opportunity. The market is paying a premium for its stability and its dividend, not for its potential to grow like crazy. Which leaves us with one final and, I think, pretty provocative question to chew on. Is CubeSmart a solid, steady income stock for a conservative portfolio, or is it a potential value trap for an investor who's hunting for growth? Based on this analysis, the answer really truly depends on what kind of investor you are.